what people often don't realize is there's many different kinds of assets out there that are leverageable and that can create access to capital. One of the most I think, underutilized, certainly the most underutilized and the most understood is actually cash value in life insurance.
You have a new deal on the table. You have maxed out all of your funding. You've talked to your mortgage broker. You've talked to your bank. They're like, we love you, but we don't have any more money to give you. You've talked to your joint venture partners. They don't have any money left on their HELOC. And you are wondering, I have this screaming deal. Where do I find the money to make this deal happen? And I am joined today by Richard Canfield from Wealth Without Bay Street. Richard has been telling me about this fantastic new strategy he has that is going to help us as investors be able to access funds and access capital that we didn't even know was available. Thank you so much, Richard. Let's dive right in. Tell us where we can find some money, because money makes the world go round.
Yeah, absolutely. And I mean, the thing that we do is we help people often find underutilized money or underutilized capital. And when you're in acquisition mode as a real estate investor, which most of the time anyway, you're always looking for the capital you need to close the deal. And different deals require different capital amounts. And at different times, all of a sudden next week, the lending rules changed and your deal, hey, you would have got it through underwriting maybe last week, but this week there's a new glitch in the system and you can't close on that property. So you always want to start to seek other access points to capital that you can try to find. So what people often don't realize is there's many different kinds of assets out there that are leverageable and that can create access to capital. One of the most I think, underutilized, certainly the most underutilized and the most understood is actually cash value in life insurance. So that is an untapped resource for many Canadians, certainly for many Americans as well, where there might be capital available there that can be utilized to fund deals. And it could be your own resource. So maybe you're listening and you're like, oh, geez, I got a cash value policy. I wonder how much is in there. I've never tapped into it before. So that right there, that could solve the problem potentially for a deal you've got on the table. But more specifically, I think a question that's not being asked very effectively by real estate investors when they're seeking or bringing on joint venture partners is, what are some of their other resources? Yeah, you'll find out about the HELOC that they've got, and you've maybe done a deal or two with their HELOC. You found out maybe how they can help you on some qualifying to close on, first mortgages and things on the deal, number of things like that. Maybe they've moved capital. Maybe you put on some RSP second mortgage money on a deal to free up some capital, right? There's other sources that you've tapped into. But if you're not asking the question, do you have any cash value life insurance? You're missing a huge opportunity of untapped resources that might be there to help fund your next deal. So, if you think about this, most people, as they're bringing on joint venture partners, in your first couple of deals, you're just kind of asking everyone under the sun who's willing to invest in some real estate with you. But
Yeah.
once you go through that process enough, you start to build a bit of a vetting process. Maybe you have a form that they fill, you do kind of an interview, and you go through some line items to determine where's the reservoir of money coming from. If your questionnaire doesn't have a question on there, do you own or have any cash value life insurance? It needs to be on there, because that's a high possible utilization source for your JV partner. Now, if there's many ways that they can access money off those policies, often with the insurance company, they can do it directly. It does depend on the structure of the policy, and we don't need to kind of go into all that minutia here in our conversation today. But they can have, for instance, a whole life policy, or they might even have a universal life policy. Structurally, there's some differences there. I don't want to, distract away from that too much, but the way that they're able to access or how much capital they could access might vary based on those two different dynamics. So just be aware of that. For your purposes as a real estate investor, it's less about what the type of the insurance is. Who cares? Do they have any cash value and can we tap it? Right? That's the thing. Most likely there is a way to tap it. It's just a matter of, is there enough in place? Another component of that is, if that JV partner does have a policy on hand, well, probability is reasonably high that they're still putting capital in there. If they're still putting capital in there, well, then next year there might be a little bit more cash value available. Or 2 or 3 years down the road, maybe it's grown a little bit. Maybe you used some to go fund deal A and you're now on deal G, and you want to reach back out and send an email to your list saying, hey, who's got some more cash value available. So depending on what, what your total resources are, your network and that sort of thing, I don't think you have to throw stones very far before you bump into someone that has some underutilized cash value in their reservoir. Now, I'll give you a quick example of one, and just from a very small level. I used to be a licensed realtor in the Edmonton area for a number of years. I've done a number of different things in my life, as most people can say,
Lots of
and
hats.
lots of hats, yeah. And so I remember, so I would ask this question of people, and as I began to learn more about it myself, and I was helping a young gentleman buy his first place. He was about 32 or something at the time. He's a great guy, and he was referred to me by another good friend, and he specifically wanted to get a property that he could have a basement suite in. Okay, so in the Edmonton market. So turns out we were looking at stuff that he was pre-qualified for, and the kind of properties that he could get in his pre-qualified level and the down payment he had available, they were feasible, but not so great. Like they would probably need 10 or 50 grand of extra capital to really make them functional. And that just wasn't, feasible in his world. So we'd found a property that was in the target area. It was in southeast Edmonton, a little bit of a lower price point with some good rental prospects. And it was a good property. He was going to be living there himself anyway, and kind of managing everything. We ended up finding this one, but it was outside of his price range. So he could hit the qualifying target, but he didn't have the down payment resource available. So I remember asking the question, like, well, let me ask this. Hey, what about your parents? What's the chance that maybe they have some cash value policy or any life insurance that has some available capital in it? And he says, I think they actually started a policy on me when I was younger. Let me give them a phone call. Picked up the
Wow.
phone, reached out to mom and dad. They had a policy in place that they had set up that they'd kind of sort of set it and forget it, which happens with parents all the time.
Yeah.
That policy had been in place, I think, for about 20 years. It wasn't monstrous, but it had like 10 grand available in it. They were able to take a policy loan out of the policy for about $5,000 or $6,000, whatever the difference was he needed to finalize the deal. And
Mhm.
then he was able to pay that back after he closed the deal at a later date. There was no requirement. So how they worked that out, was up to them. But the key is they had set up something for their son as a resource for him in his future. They didn't
Mhm.
know when or how they would tap into it. They'd basically forgotten. He didn't know when or how. He needed the property. We found the capital. We closed the deal. He got a great property. He was able to rent the basement suite, a number of months later after some minor tweaks, I think for $1,200 a month. Basically got to live, for, less than $1,000 a month in this property that he owned, and he never owned a piece of real estate before, had an
Mhm.
asset to help for his future, and he was able to tap another asset that was already set up for his future. So there's a lot of wins that we can strike off the list here. And we're not talking about monstrous amounts of money, but the
Mhm.
key is in asking the right questions to see where that resource might be, and is it viable, and can you tap it?
Absolutely. And I feel like, in 2000 and I think it was 2010 when the government came in for Canadian investors and said, hey, you can no longer buy investment properties with 5% down. You now need to put 20% down. And that was when I saw the huge surge in popularity for people who are using RSPs as second mortgages, down payment funds, those kinds of things. And I feel like this is like a strategy for a more sophisticated investor. It's not that it's complicated, but it's just that it's a bit of a secret that most people probably don't know that much about this particular source of funding. And it's funny because I've done vendor take back mortgages before where I've asked the seller, will you hold financing? And they've said no. And I've said, well, do you have any RSPs? So let's swap out, give you the cash, the equity out of the property, but we'll put your RSPs in second position. And they've gone, oh, yeah, I can do that. I'm happy to do that. I feel like this would be a great strategy with sellers too, to see, okay, maybe you don't want to leave your cash in the property, but maybe you have a life insurance policy and you can pull some money out and put that in, and it'll help out you as a seller. It helps out me as a buyer. So you could use it for JVs and sellers.
Yeah, absolutely. And I think your point about, that transition, hey, you got to put 20% down, which it used to be like that. Used to be, I remember the first rental property I bought, it was 25% down. And so, these rules do change over time. And
Yeah.
so you have to be able to maneuver with those changes as much as possible. That's why good coaching is really important. What's
Absolutely.
really interesting is, you take a look at, as an example, again, somebody, especially when you're dealing, like in that example, you're doing VTBs with something, maybe that person has cash value they can use to help fund the VTB or whatever, or place it on the second, so they can show them how you can get another earning potential off that piece of real estate that you just sold me, right? So that kind of capacity. What I think is really interesting though is you, as the professional real estate investor, if you're seeking to bring capital to you, you need to set up the right environment to make yourself attractive to capital. All right. Capital wants to be preserved. So if you're
Mm,
bringing in joint venture partners, you want their money to help you realize your goals. Well, you better be able to demonstrate very clearly how, by them giving you that money, you're going to help them with their goals. All right. If you can't do that, you're going to have a mismatch, and you're probably not going to attract a whole lot of capital. Well,
yes.
think about all the risks to the joint venture partner. We can isolate the risks in the real estate deal, and a spreadsheet and a pro forma and some market research can help you do that, and some good coaching.
Mhm.
All right. And then just intuitive experience, those things will help mitigate that risk. However, a risk that is always present that most people never think of when you're the real estate joint venture expert is the risk of the expert being taken out of the equation. So, so you
Yes.
so imagine you're driving around looking at some of your properties, and you got JV properties all over the neighborhood, and you're out for a tour, and you're going to go knock on some doors and go do some walkthroughs on a few properties to check in how bad the tenants of kids have drawn all over the walls or whatever. And heaven forbid you go and get taken out at a stop sign from a car accident. So I hope that doesn't happen, but it happens because we can't control those events. Now, the real estate expert's out of the equation. How does the joint venture partner get their money back?
That's a great
Who,
question.
who's helping them get their money back? Does the joint venture partner have any idea how they're going to do it? How do they have to deal with the rent roll? Who's in place to take care of the rent roll? Who makes sure that a share of that rent keeps coming back to them? What happens if
Yeah.
the mortgage payment's no longer getting made and that property goes into foreclosure and there's extra fees? How do you get your capital out? You see what I mean? These are
Yes.
real challenges that are rarely addressed by most real estate investors. But if the real estate investor is leveling up and thinking, I want to attract capital to me, if I can demonstrate very clearly in my, sales pitch on how I'm
Mhm.
going to help protect and preserve someone else's entrusted capital, you're probably going to get a lot more referrals and a lot more capital.
Yeah,
Well,
you're absolutely right.
if you yourself are well insured as the joint venture expert, as the real estate expert, and you can now show, hey, look, if something happens to me, a bunch of money shows up to fill back the pot, and my spouse or my family has instructions that they can make sure to buy out joint venture partners' original capital, so their capital is
Mhm.
preserved.
Mhm.
And then you're out of the JV partners out of the deal. The rest of that property stays with the family, but you got your capital back. There's different ways to build and construct that. What I'm getting at as the insurance aspect of being able to access cash value is just one aspect of where you might be able to track capital. But if you also are setting yourself up for success to make sure you're being a good steward of someone else's money so that they can have their trust and their faith in you, that even if you mess everything up horribly, if you kick the bucket, there's a good chance they're getting their capital back. Right. So that's the type of thing that's really advantageous. Here's another quick story for you. I have a client of mine, amazing guy, a real estate investor out of Calgary. I love this guy. I've known him for like 20 some odd years. He's just amazing. He did a deal with a fella where he put the down payment in for, as a joint venture deal, where the guy was going to buy his own house. It was a 5% down deal where there wasn't a lot of any cash flow or anything, but it was this long-term kind of buy and hold strategy. And, 6 or 7 years out, there'd be maybe a refi. He would get his capital back and he would own 50% of the property. Does that make sense?
Yep,
So
absolutely.
you could be in the deal for less capital, and it was all in, appreciation, kind of a mortgage pay down kind of a play. Well, lo and behold, the Alberta marketplace took a kick in the nuts a little bit for a period of time there. I don't know if anyone's read that in the paper. And and that gentleman ended up having some other financial difficulties, and he ended up being in a position where the property ended up going into foreclosure, et cetera, et cetera. There wasn't a way to recover the capital. Well, my client knew enough about insurance at that point that he made sure he went and got an insurance policy on the guy who went into foreclosure. So he did that in advance. My client was the owner of the contract. And that policy is, I don't remember the value was, let's just say it was $200,000 or something. There's an age gap between the two of them. One fellow's like 55, the other guy was like 30 when this deal got done. Well, the younger guy's probably going to outlive the older guy. Can we all agree that that's the case? All right. We
Yes,
don't know for
statistically,
sure.
absolutely.
High probability. All right.
Yeah.
So my client may never see his original capital back. He probably will in time and cash value, but maybe not in his lifetime. But he's got 3 kids. His kids are going to get a multiple of that original down payment money back.
Yes.
Unequivocally.
Yeah.
By the virtue of the contract. So there's ways that you can set protection mechanisms in place that protect your joint venture deals for you as the money person, right? And then also to help protect the people that are providing the money so you can attract more of that capital. So I think that there's a multitude of like intersecting levels of the insurance realm and the real estate realm, really creating an efficient bridge to allow for more prosperity to happen.
Yeah, I love that. And to me, this is such a sophisticated strategy, you know, in terms of our role in the joint venture partnership. Most of us, when we're talking about joint venture partnerships, we want to be the working partner. We want to be, you know, the people who go and find the deals and put everything together. And I think this piece of knowledge and, you know, your tip about, you know, think about it from your partner's perspective and how do you protect them? I think it makes it that much easier for us as joint venture partners to raise the funds and the capital we need in order to keep growing our portfolio. Now, if you want to learn how to secure real estate wins and prepare for the new markets in 2023, click right here.